This is a short video from our longer oil and gas seminars. In this video, we will go over the basics of full cost and successful efforts for oil and gas accounting. If you learned something new, please like, share, and subscribe. Without further ado, here's our first seminar on oil and gas accounting and the basics.
So, getting into the accounting methods, I'm not going to touch too much on this because there's a whole section on it, but just kind of high level. There's two different accounting methods that account for oil and gas properties. There's successful efforts and then full cost. So under successful efforts, you capitalize only the costs that are directly related to specific oil and gas reserves, and only when those results are positive and economic minerals are located. So there's kind of a success versus failure concept there where, successful wells and development costs are capitalized and the costs that cannot be linked directly to economic reserves along with unsuccessful exploratory costs are expense. That's going to differ from the full cost method where all property acquisition, exploration, development costs, including dry holes, are capitalized as oil and gas properties. And then those are amortized on a country-by-country basis. So again, I'm not going to get into that in great detail. There's a whole section that kind of goes into that in more detail. Under the impairment, those models are different too between those two methods. Full cost uses this what they call a ceiling test, which uses a historical pricing versus successful efforts uses a two-step impairment test using forward-looking pricing. But again, that'll be looked at in more detail in a subsequent presentation.
All right. The basic differences, and this is just high level. Under full cost, all of the properties and fields lose their identity, and they're included in the full cost pool. And that full cost pool is based on by country. So any of our clients that might have just properties in the U.S., they only have one full cost pool. It is a challenge because they lose their identity. It is more difficult to identify the individual property in which to relate cost to. So that is a challenge that the companies face as well as we face as we go through our audit procedures. Under successful efforts, each property or field is considered its own cost pool. And so the record keeping needs to take place at a more disaggregated level. And so at the property level, and it's much more detailed, and we'll kind of see in the pros and cons later how it can be a little bit more time consuming. However, there are benefits of the fact that the detail is actually there and available. All right. For the full costs, all costs associated with the property acquisition, exploration, and development activities should be capitalized regardless of outcome of drilling. This is a big distinction between full cost and successful efforts, in which successful efforts, as you can see on here, that any dry hole cost, exploration that don't actually result in proved production, those would be expensed when they are actually incurred. So this full cost, most costs are capitalized. The largest expense is DD&A, depreciation, depletion, and amortization. And you should not see any exploration or dry hole costs on the income statement because they're included in the full cost pool and subject to depletion over time. And then both full cost and successful efforts have lease operating expenses included on the income statement. So, and we'll go into a little bit of detail. This is a nice key cheat sheet. And again, this is an easy, quick reference of which is capitalized and which is expensed, especially with successful efforts. As you can see, there's a difference between property delay, rental, and geological and geophysical cost, as well as the cost of drilling an unsuccessful exploratory well. So those are the key differences between successful efforts and full cost. All right. To go a little bit more in depth, some of the pros of successful efforts is that, and I mentioned this a little bit ago, but it's easier to value a group of assets in the event of an acquisition or sale. So you already have the information disaggregated to the property level. So whenever a company does determine that they want to go and get and sell the properties, it's easier for them to determine the costs that have already been incurred to date for that property. This is very beneficial for companies that actively purchase and sell properties, as all the information is readily available and it hasn't lost its identity in the full cost pool as with full cost. This is recommended by the SEC, IFRS, and FASB. Actually, under IFRS, their accounting for oil and gas is very, very similar to successful efforts. Full cost is not a recognized method of accounting under IFRS. So another pro is that it forces the company to track the revenues and expenses by property, and it just provides a better internal analysis, which can be utilized, to determine how the properties are doing and whatnot. Additionally, the impairment in situations where there is an impairment, they can be limited to a specific property or field rather than the entire cost pool. Also, I think one of the cons would be the higher administrative cost. As you can imagine, including all of this information for individual wells can be very cumbersome for companies. And so there is an additional level of administration in as it relates to tracking these costs, as well as the associated depletion and impairment, on these field bases rather than the full cost pool. And then also whenever the information is being gathered for the accounting department, it does require additional time and additional disclosures in the financial statements. So those are some cons for the successful efforts. For full cost, some of the biggest pros are it's just one depletion and impairment calculation performed. It makes it a little bit easier and cleaner because all of the costs lose their identity by property. So it's all in one full cost pool. And so this is favorable for small companies as it gives it a positive outlook of income, and also just easier to keep track of. And then it also encourages smaller companies more aggressive in exploration. As I mentioned before, for a dry hole cost, those are expensed under successful efforts. And so a smaller company that might not want those big hits to the income statement because they're expensed, using full cost allows them to capitalize them and then deplete them over the life of the full cost pool. Some of the cons would be that it's harder to value a group of assets. And so if you have, if a company is using full cost and they're wanting to sell off a portion of their assets, it may be more difficult for them to find the information related to those to actually determine the amount of cost already incurred. And then also earnings may be inflated from an investor's perspective, particularly as it relates to exploratory wells or items that wouldn't otherwise not have already hit the income statement. And so it's a delayed hit to the income statement on if there are drilling several or exploratory or unsuccessful dry holes. All right, so this is a pretty intense chart, and again, these will be provided to everybody after the presentations today, but we just wanted to go ahead and give you a nice flow of different costs that you may encounter during, while we're looking at these, companies' CapEx cost. Some of them for under full cost, as you can see, anything that is incurred prior to the development and production of the well, including acquisition, exploration, and development costs, are all capitalized on a countrywide basis and then included in the full cost pool. And then there are some temporarily excluded costs from amortization, which included the direct costs related to acquisition and evaluation of unimproved properties. So those are the ones that are excluded from the depletion base, and that will be that'll be discussed a little bit more in detail later on in the DD&A and impairment section. But just keep, as this chart is showing, that most of these costs are capitalized until you get to the production phase, and then as with successful efforts, full cost production costs, LOE, are expensed, so they hit the income statement in the period that they're incurred. Right. Okay, and over here, this one is a similar chart, but now for successful efforts. And you can probably see the difference between the two, in which the acquisition costs are capitalized. However, when you get into this exploration cost, it depends on whether or not they're successful and if they need to be expensed immediately. So this is one of those key factors that whenever we're looking, or a company is working through exploration wells, it's important to know the success of it and to know whether or not those costs should be capitalized or they should be expensed based on if they're a dry hole or not. Another thing to keep in mind that, if you have a full cost company, we shouldn't see dry hole costs on the income statement. So if you see that, that's definitely a question that we want to ask as to why there's dry hole cost included on a full cost company. And then from a successful efforts, keep in mind that we want to make sure that any costs that were incurred were successful, and that they are properly capitalized or put on the income statement based off of the success of them.
So let's wrap up there. Comment with any additional questions you may have, and we can expand and help. Please subscribe so you don't miss any new content. Hey, before we continue, let me quickly tell you about a collaboration we are doing with the TB4A Shopify account that can save you some money and help support the channel in the process. Are you an accountant with a sense of humor, but are having trouble expressing that in the third meeting this week about account reconciliations? Maybe you're struggling to find that gift for your accountant friend or their new kid. Or maybe you're struggling to find some not-so-average office gifts. If so, check out TB4A's Shopify and get all the great business comedy gear. They're uploading new items each week. Use my code ACCOUNTINGACADEMY, all one word, for 10% off your purchase. Each sale will indirectly support this channel. Imagine bringing this fun cup to your next pointless meeting. So check out the link and see what you can find. Now back to the video. All right, folks, thanks so much for watching. Please like, share, comment, and subscribe. And if you can, donate at Patreon. Anything you can give helps to keep the lights on and ensures we can continue to create content. And of course, helps feed FIFO. If you want to contact us about anything you saw in this video, accounting advice, or ideas for future videos, contact us at patreon.com/accountingacademy.
This video is designed to be illustrative and does not represent an official position. We make no representations, warranties, or guarantees and assume no responsibility for the application of this material. Please seek advice from a competent professional if expert assistance is required.